You opened your banking app this morning, maybe to check your balance, maybe to see if a payment cleared, and somewhere between logging in and closing the app, you saw at least 2 or 3 things your bank was trying to sell you. A credit card offer, a personal loan, a premium account tier with benefits you'd probably never use. And you scrolled past them the way you always do, barely registering them as anything other than background noise. But here's the thing about that background noise. It isn't random. It isn't just marketing. It's the visible surface of a business model that is, when you look at it clearly, specifically designed to profit most when you have the least. That's a sentence worth sitting with. And I don't say it to be dramatic or conspiratorial. I say it because understanding how your bank actually makes money is one of the most practically useful pieces of financial knowledge you can have. My name is Threk, and I spend way too much time thinking about money, financial systems, and the quiet structural ways that everyday banking either helps you build wealth or quietly works against it, depending on how financially vulnerable you are. And by the end of this video, the way you interact with your bank, the products you accept, the accounts you keep, the fees you pay, is going to look completely different to you. Because this isn't about your bank being evil, it's about understanding the incentives. And once you understand the incentives, you stop being a passive participant and start making deliberate choices. Let's start with the most fundamental thing, which is how banks make money. And most people have a vague understanding of this, something about interest rates and loans, but the full picture is more interesting and more relevant than the vague version. Banks take the money you deposit and lend it out to other people and institutions at a higher interest rate than they pay you to hold it. The gap between what they pay you on your deposits and what they charge borrowers is called the net interest margin, and it is the core engine of banking profitability. So when your savings account is paying you 0.4% and your bank is lending money out at 7, 8, 15%, that spread is where the profit lives. Your idle money is being put to work for the bank at a return that dwarfs what you're receiving for providing it. Now, this isn't inherently sinister. That's how banking works. But here's where it gets relevant to you personally. Banks are most profitable when your money sits idle in low-yield accounts, when you carry revolving balances on credit products, and when you trigger fees. 3 specific behaviors, idle deposits, carried balances, and fee-triggering behaviors are, not coincidentally, the 3 behaviors most associated with financial stress and low financial literacy. The business model doesn't just tolerate financial vulnerability in customers, it profits from it. The overdraft fee is the most naked example of this. You have $5 in your account, a $12 subscription charges, and you're hit with a $35 overdraft fee. The bank just made $35 from your $5 shortfall. People with chronically low balances, the financially stressed, the paycheck-to-paycheck crowd, pay overdraft fees repeatedly. People with healthy balances almost never do. So the fee structure is, in practice, a tax on being broke. The less money you have, the more you pay for the basic infrastructure of having a bank account. The credit card is the second layer of this. And look, I want to be fair here. Credit cards used well are genuinely useful financial tools. The rewards, the fraud protection, the float. But the entire credit card business model is built on the assumption that a meaningful percentage of cardholders will carry a balance month to month and pay interest on it. The rewards programs, the cashback, the points, the miles are funded almost entirely by the interest paid by people who don't pay their balance in full, people who are financially stretched, people who charge expenses they can't fully cover and roll the balance forward. So if you're a rewards card user who pays in full every month, you are, in a very real sense, being subsidized by people in financial difficulty. The math only works because someone else is paying interest. The third layer is the products your bank markets to you when you're financially stressed. Personal loans, debt consolidation offers, balance transfer products, buy now, pay later integrations. These are presented as solutions, and sometimes they genuinely are. A lower rate debt consolidation loan might actually help someone reduce their interest burden. But more often, they're solutions that extend the duration of financial dependence rather than resolving it. The bank isn't primarily motivated by your financial recovery. It's motivated by adding a new interest-bearing product to your portfolio. So what do you actually do with all of this? Because understanding the system is only useful if it changes your behavior. The first move is to stop keeping idle money in a low-yield checking account beyond your immediate needs. High-yield savings accounts, typically offered by online banks rather than traditional brick-and-mortar institutions, often pay 10 to 15 times the interest rate of a standard savings account. Moving your buffer, your emergency fund, your short-term savings there doesn't require closing your main account or changing how you operate day to day. It just means your idle money is working slightly less hard for the bank and slightly more hard for you. The second move is to treat overdraft protection as an emergency kill switch, not a convenience feature. Opting out of overdraft coverage means declined transactions instead of fees, which is genuinely less convenient but dramatically less expensive if you're in a period of tight cash flow. Better still, building even a small buffer in your account eliminates the problem entirely. The third move is to understand clearly which side of the credit card business model you're on. If you carry a balance, you're the revenue. If you pay in full, you're the cost. Knowing which one you are changes how you relate to the product. And if you're currently the revenue, making a plan to become the cost is one of the highest return financial moves available to you, because credit card interest rates are among the most expensive money you can borrow. None of this requires leaving your bank or dramatically restructuring your financial life overnight. It requires seeing the system clearly enough to make deliberate choices within it, to stop behaving in the ways the system profits from by default, and start behaving in the ways that redirect those profits toward your own balance sheet. Your bank is not your financial partner. It's a business with incentives. And like every business, it designs its products around those incentives. That's not a reason to be angry, it's a reason to be informed. The customers who cost banks the most money are the ones with high balances, no overdrafts, full credit card payoffs, and no unnecessary fee-triggering products. Become that customer. Not because it punishes the bank, they'll be fine, but because it means you're operating the relationship in your favor rather than theirs. You already handed them your deposits. Make them work a little harder for the rest.